I'm going to talk to you today about how Intelligent Investor has beaten the market consistently for 15 years. There's not too many managers with that sort of track record over that sort of length of time. And we've done that because we've followed a specific strategy and we've followed it consistently. So I'll talk to you about that strategy, and then I'll give you some examples using some of our recent recommendations and portfolio inclusions that highlight how we put that strategy into practice. First of all, some of the obvious, what we're trying to do is put a portfolio together. So we're not trying to maximize returns out of one single idea. What matters is not a stock return. What matters is your portfolio return. And your portfolio is just the number of stocks you're holding. It's an important distinction because it's okay to lose money on a single stock, on a single idea, and we expect to do so every now and again. But if that's all you focus on, I think you do damage your ability to focus on that portfolio return, and that's the aim of the game. So it's important that we're focused on our overall returns, not on a single stock return. We want to be able to hold a portfolio that's as undervalued as possible for a given level of risk. And we do that simply by holding. That has been the key source of our outperformance. We don't channel our inner trader, and we don't engage in frenetic activity. We have very low turnover of ideas. We have very low turnover of our portfolio. What we do most of the time is find a good idea and hold it. And that is the key to doing well. We need to channel our inner Zen monk. We need to practice patience and discipline and doing less. And that's something that the rest of the market doesn't do very well. It's not counsel you hear very often at all, but it is something that we practice and that has worked very well for us. If we're so smart, why don't we just hold a single stock? Well, because the world is filled with uncertainty. So we generally hold between 12 and 30 stocks at any one point in time. And we do that because we don't know what tomorrow is specifically going to look like. Every time we add a stock to our portfolio, we're taking a calculated probabilistic risk about what the world will look like. We think that idea is well researched and has some foundation, but we're very open to the possibility that that idea may also be wrong. And so to protect ourselves from an uncertain future, it's really important that we diversify and hold a basket of stocks. It's something that we call the Rumsfeld principle. Ron put a picture of 3 dead Nobel Prize winners on the screen. We don't need a Nobel Prize to understand that there are 1,000 different futures possible, but we only ever get to walk one of them. The problem is we don't know which future we're going to walk by. Donald Rumsfeld, one of the great philosophers of the 21st century, summed it up really perfectly. He said there are known knowns, there are unknown knowns, and there are unknown unknowns. And after you contemplate that for a day or two, you realize what he's saying is that the future is inherently unpredictable. There are things we will not know. So please focus on portfolio returns, hold a basket of stocks. Don't just put all your money into one stock, no matter how well researched, how convincing, or how smart you are. We think in probabilities. So we don't have certainty about the future. We think an outcome may be likely to a particular probability, and that's the way we think. And by doing that, we're able to effectively evaluate price and risk together. And those two things, price and risk, need to be considered together. I said before that it's okay to lose money. It's a really important way to manage your affairs, but not one that many investors would come out and tell you. There's very few people who come out on stage and say, look, it's okay to lose money, but it is. If you're not losing money a little bit of the time, you're probably not trying hard enough. The best fund managers in the world will only make money on 6 or 7 out of 10 ideas. And that's okay. The aim of this game, essentially, is to maximize your portfolio return. So it is okay to take a probabilistic gamble or a probabilistic investment and not have that work out. That shouldn't be the end of the world. It's an important mindset to accept because it allows us then to take on risk and to take it on intelligently without destroying our psychology or destroying our returns. And another way to maintain our psychology and maintain our returns is to use a definitive process and not to make wild predictions. So you'll never hear us say, electric cars are taking off, lithium's taking off, let's go buy lithium stocks. For me, that is buying into a whole series of certainties and then coming to an end prediction. You have to accept that electric cars will be the future. You have to accept that lithium will power batteries that go into electric cars. You have to accept that battery producers are not going to screw the lithium producers, and that lithium producers are going to end up with a significant chunk of the profit pool. So there's a whole series of bets you're taking when you're making a prediction, and all of those bets are steeped in uncertainty, and we don't know the outcome. Our method is to prepare, not to predict. We have a process, and that process allows us to take probabilistic bets. So we weigh all those items in a probability weight, and that helps us decide whether we invest in an idea or not. We don't have a certain view about the world and then make our investments fit into that worldview. I think that's a really easy way to lose money. What we're trying to do, and it's good to remind yourself of this every time you make an addition to your portfolio or make a change to it, remind yourself what you're trying to do. What we're trying to do is to buy something for less than it's worth. And that may seem obvious and simple, but it actually excludes a whole lot of different aims. What we're not trying to do is buy the best quality company we can buy. We're not trying to buy the cheapest company we can buy. We're trying to identify what something is worth and then buy it for less than that. I have no interest in curating a collection of expensive but high quality companies. Most fund managers will tell you they want to buy high quality companies with great management and blah, blah, blah. But that's not the way to make returns. The price you pay for a business will ultimately determine the amount of money you get out of it. And when you buy something expensive, that you're already handicapping your return. So we need to weigh up the quality of a business against its price, and we do that by trying to understand its underlying value and buy at a discount to that underlying value. So all value investing is the hunt for mispricings. What we do is mostly look at a whole bunch of companies, trying to understand what they're worth, and then look for reasons why this company may be mispriced. It's a really important distinction between our method and the method of others. We don't make predictions. We don't make worldview bets. We try and find mispricings in the market and exploit them. And to do that, you need to be looking where other people aren't looking. You can't make superior returns from the crowd and be doing the same things as the crowd. You have to do something different. And that is what we're trying to do every day. We're trying to do things different to everyone else. And by looking for mispricings, I think that's the best way to do that. One of the tools we use is called second-order thinking. It's an idea first put forward by a big hedge fund manager in the US called Howard Marks. Howard Marks says that most people in the market employ first-order thinking, which is taking a trend or an idea today and extrapolating in a straight line to tomorrow. The world is buying more electric cars. Electric cars use lithium batteries. I'm going to buy a lithium producer. That is linear thinking. That is first-order thinking. We need to go beyond that and employ second-order thinking, which asks a whole series of different questions. Second-order thinking posits, yes, the world is buying more electric cars. Yes, lithium is the feedstock for those batteries, but lithium is abundant. A lot of capital and a lot of competition is being attracted to that industry. Are the returns being employed today going to be there in the future? It's a different series of questions that's asked of the same series of facts. And it's an example of how we try and do something different to everyone else. Now, All that method is carefully assembled and put together to come up with individual stock ideas. And we have a whole collection of them. We've been doing it for a long time. We have a series of recommendations, and we also have 2 funds which we use recommendations to put together portfolios. One of the stocks that's in all of our portfolios at the moment is a business called AMASIM. It currently sits in our growth, in our income, and our small cap portfolios. It's a stock I own personally as well, and it's been a recommendation of ours for some years. Now, AMASIM, many of you may not have heard of it. It's a mobile phone business. AMASIM purchases spectrum or bandwidth from the Optus network, and it bundles that up into its own products, and it sells SIM cards and access to mobile phones to its own customers. It's a very simple business. It's currently got a market cap of about 400 million, and we think it's cheap. Now, when we first came to AMASIM, it was trading on a PE of about 70 times, and the market didn't like it. It was expensive. People were saying, look, it's just a mobile reseller. There's no real advantage in this business compared to a competitor. It's a hostage to Optus was the common refrain, that this business exists at the pleasure of Optus. They could cut their contract off and the company would cease to exist. It's a fragile business with fragile economics. This was, I think, an example of a mispriced opportunity. The consensus had one view of the company and we had another. We saw this business and we thought, yes, it is a competitive market. Yes, it is reliant on Optus. But the economics of this business are actually really attractive. Now, AMASIM operates because it has built a technology stack that allows it to offer its products and bring on new customers to its platform without anyone really interfering. So it's a automated product, and that means it can operate at extremely low cost. So when you walk into a Telstra store and you sign up for a mobile plan with Telstra, that will cost Telstra 10 times as much as if you jump on AMASIM's website and you sign up as an AMASIM customer. So its cost of customer acquisitions is about 1/10 of Telstra's cost. Its cost of sustaining that customer is really cheap. It costs Telstra about $18 a month to keep you on board as a customer. It costs AMASIM between $3 and $4 a month to maintain you as a customer. And as this business grows, because all its costs are upfront, the cost of the software, the cost of the platform, and the cost of the first round of customer acquisition, that's all an upfront cost. All the additional cost is really low. So you end up with a business that has improving margins as it grows, strengthening economics as it gets bigger. We first bought this business when it had about 700,000 customers and it was just profitable. It took this company 600,000 customers to be able to turn a profit. So you imagine if this is such a competitive, simple business, there is no other reseller with anywhere near as many customers as AMASIM. AMASIM has more than 50% of the market when it comes to mobile resellers. Our view was that as this business grows, its margins will actually expand. So the market is forecasting margins for this company that are way too low. We first bought this business with EBITDA margins of 7%. It now has EBITDA margins of 15%. Those margins have doubled as the number of customers has grown. Our investment case is working out. The company is a lot better today, and it actually generates a good amount of profitability. That PE has come all the way down, and despite year after year of very good financial returns from the business, the share price has barely moved. So this still remains a business on our buy list, and it remains probably a better idea today than it was when we first bought it. The other great thing about this company is that because it leases a network and doesn't own it, it doesn't have to reinvest capital into maintaining an expensive mobile network. Every year, Optus and Telstra have to spend between $2 and $3 billion every year maintaining their mobile network. Last year, AMASIM paid less to Optus to lease its network than it did the year before. So AMASIM is capturing the benefit of all of Optus's CapEx and not paying for it at all. They're actually getting a cheaper price for a better product. And these sort of economics are sustainable. Every year, Optus will fork out more money for its network, and every year, AmazSIM will gain the benefit of that expenditure without putting up the cost. And that also leads to very high free cash flows. Optus will get lots of money in, and it will spend lots of money to fix and maintain its network. AmazSIM gets lots of money in and can keep that money without having to fork out expenditure. So the free cash flow of this business is really cheap. It trades on a relatively high PE of over 30, which scares off a lot of people. A lot of people look at that and think, I'm not paying 30 times for a reseller. But the free cash flow is much better. The free cash flow yields about 7 to 8%, and that is actually growing. And rather than AmazSIM being hostage to Optus, I think it's actually the other way around. AmazSIM has grown so much so quickly, it now represents 10% of Optus's entire customer base and all of their growth. If you take out AmazSIM from Optus's mobile subscribers, you can see that Optus has not grown at all over the last 6 or 7 years. All its growth has come from this business. AmazSIM is not hostage to Optus, Optus is hostage to AmazSIM. And as the mobile market gets more competitive, this pool of 1 million subscribers that's growing quite quickly is going to become more valuable. It's going to become a strategic asset. And those sort of options aren't priced into the business today. So we were able to look at the same information that everyone else had access to, the same metrics and the same detail, but we were able to come to a different conclusion because we view the world in a particular way and we have a process that allows us or formalizes that view. We saw that AmazSIM was not being priced for its potential, that this was a business that will actually increase its margins as it grows, that will strengthen its economics as it gets bigger. We saw that it was a capital light business that won't suck in cash and will throw off a lot of free cash flow. The model inherent in AmazSIM's operating ship is a high return on equity, high free cash flow model. You can't say that of any of its competitors, or you can't say that of any of the mobile operators. And best of all, the economics improve as it gets better. And that's the key that was being mispriced. People were viewing AmazSIM as a static set of numbers. Our view was that these set of numbers were actually getting better as this business grows. Now, the other company we've recently taken a look at and bought for our own portfolios is Woodside Petroleum. We only bought this about 2 weeks ago in our portfolios, and it's one that we've been watching for a long time without really taking much action. Now, everyone would have heard about Woodside. Woodside is a LNG oil and gas business. It's a huge company, over $20 billion. Trades on a PE of about 18, which is not very cheap. If you're just looking at low PE stocks, this probably wouldn't pop onto your radar. You have to dig a little deeper to see the attraction of Woodside. There's a strong negative consensus about this company, and that's almost a prerequisite when we're looking at a business. We want to buy something that other people aren't looking at, that other people aren't buying, and that means buying into a bad narrative or some bad news or some warts. And Woodside certainly has some of those. There has been zero production growth coming out of Woodside for years. In fact, if you view an oil and gas company as a pool of oil and gas assets and production as simply a process of churning oil into cash, then Woodside is actually a shrinking company because its pool of oil and gas has been shrinking in recent years. And that's why its share price has fallen so much. There's a correct view that this is a business well past its prime with a dwindling pool of assets. This has been called a liquidating trust, a business that is getting smaller and smaller every year. There's also a consensus that there's very little oil price leverage in this stock. We're in pretty tricky times for the oil price. It's fallen well off its highs. There's not that much interest in buying an oil stock. Those who want to buy an oil stock want to buy it because they think oil prices are heading higher. And Woodside is a low-cost producer. So your leverage to higher oil prices is limited. If you believe oil price is going to be high and that's why you're investing, you're better off buying into a high-cost oil producer rather than a low-cost one. And Woodside doesn't fulfill that. So the guys who are really strong on oil and want exposure to the oil price, they've been buying Origin and Santos, whose share prices have basically doubled, while Woodside has done nothing. And of course, we've already covered that it's not cheap on an earnings basis. A PE of 18 is not particularly cheap. Again, we looked at the same information on Woodside and came to a completely different conclusion. We think that the value of Woodside is not in its oil and gas in the ground, but it's in its infrastructure above the ground. There are changes in the LNG market that will make the infrastructure that Woodside houses much more valuable in the future. And I think that's the key to extracting value from this company. From the day that LNG was invented, it's been developed in the same way. You find yourself a very big gas field. I should probably explain, we might not be familiar with LNG. LNG is simply gas that's been chilled into a liquid form and then transported on ships, a bit like oil. The problem with gas has always been that it's this whole series of molecules. You can't transport it from one spot to the other without the use of pipelines. And that means that to have a gas market, you need a heavily pipelined market. So there's no such thing as a global gas market. There are only regional gas markets that are connected with pipelines. And that's always been a problem for commercializing gas, because most gas is not near populated areas. So you need a way to get gas from where it's discovered to where it's used. And that's where LNG comes in. LNG projects take large gas resources, turn them into a liquid, ship them, and then heat them up into a gas again where they can be distributed. It's a really important technology that's allowed for a globalized gas market. So the same, for 20 years or 30 years, LNG has been produced in the same way. You find yourself a very big gas field, and after you found that gas field, you go off and find some customers. Typically, Australian and European, Middle Eastern producers have found customers in Asia and in Europe. So they go to those customers, sign up 20 or 30-year contracts that guarantee that those customers will buy LNG cargoes for decades and decades. You then take those contracts to the bank or to the equity markets, and you raise tens of billions of dollars to build your LNG plant, and then you get into production. Now, that's been the way that Woodside has grown. That's been the way that every LNG producer in the world has done it until now. It's all changing now. And it's changing because the number of LNG buyers and the number of LNG sellers has massively expanded, and there is now a spot market in LNG. Gone are the days where you could find a buyer for 20 or 30 years. Most buyers will make either shorter term contracts or will engage the spot market to buy LNG as it's needed. And that changes the dynamics of the LNG market. That makes it much harder for new projects to come on stream. Without those 20 or 30-year guarantees, very few companies are going to front up the 20, 30, $50 billion it takes to build an LNG project. The Gorgon project is now at up to $70 billion in capital costs to produce. So if new projects aren't going to be brought online as easily, that makes companies with existing infrastructure really valuable. Existing infrastructure can be used to enhance production simply by plugging new gas sources into it. So Woodside has a declining asset base, but it has a terrific infrastructure base. To increase production, what it needs to do is not to spend $20 or $30 billion building new plants. It just has to make agreements with other gas producers to fill its existing plants with more gas, and presto, you get more LNG at the end of that process. It means that Woodside won't be showing on its books growing gas reserves, because the future growth of this company won't be in its own gas resources, it will be in processing gas for other people. So the problems with Woodside that people see on its books are largely problems of accounting, because the gas that they'll be processing isn't gas that's recorded as theirs, but it will be produced. It also means that they can generate production growth and generate it cheaply. I think the days of big companies spending tens of billions of dollars on new LNG developments are going to be over. And Woodside is running out of gas in its prime northwest shelf. It will be out of gas by about 2020. That's one of the reasons it's cheap. People are really concerned what's going to happen when its biggest asset runs out of gas. All the infrastructure there is first rate. They will simply plug new gas resources into that infrastructure, and you should have production going, which will increase the value of the company. The payoff structure is also really attractive. We made a criticism of Woodside a few years ago, saying that its dividend payments were too high. that was making a lot of money, but it was reinvesting all that money simply in paying dividends and wasn't reinvesting it back into that business. Well, that's changed. Woodside has recently made several very intelligent purchases to give it some optionality about increasing resources. It's bought the Wheatstone LNG project for less than book, and it's gone into really attractive gas-rich areas, Senegal and Myanmar, and it's done that very cheaply and very slowly and intelligently. So it's not part of our investment case, but it is possible that you get a much bigger payoff at the end than you anticipate at the beginning, and you're not being asked to pay for that, and I think that's really attractive. And of course, we haven't even spoken about oil prices. We don't have a case that sees oil prices needing to rise for Woodside to do well. Woodside is a low-cost oil producer, which means it doesn't enjoy the same leverage to higher oil prices, but it doesn't sustain the same damage if oil prices fall. And I think that's been forgotten at the moment, but it is really important. We don't need oil prices to rise from here, but if they do, then that's an added bonus to the value of this company, but it's not embedded in our investment case. That's the sort of thing we like to see quite a lot. We want to buy something at a discount to what we think it's worth, and then have a free option attached to it. We're not paying for that option, but if that option comes out, if that's a path the future takes us down, then we get the benefit of that without paying any of the cost. So again, we were able to look at the same information at this business that everyone knows really well, that's covered by dozens of analysts around Australia, and come to a very different conclusion. We thought that the reserve replacement ratio is a really important number when looking at oil and gas stocks. It tells you how quickly a company is replenishing its oil reserves, and that ratio has been a disaster for Woodside. It's been falling quite a lot, and it's one of the key reasons why this business has not grown. But we think it's an imperfect measure, because the future growth of this company is not going to come from its own gas resources. It's going to come from employing its valuable infrastructure into production of other people's gas. The LNG market is changing, and new LNG projects will be more difficult to fund, more difficult to construct, and that means existing projects with spare capacity, the infrastructure on those projects is going to be more valuable. Woodside, even on its books, you might think, well, the most valuable part of Woodside will be its oil and gas. 70% of its book value comes from infrastructure rather than oil and gas. And we think that infrastructure value is already undercooked. And low production costs. I mean, we live in a crazy world. People looking at Woodside saying the low production costs are a disadvantage rather than advantage. They are a great protection. And a risk-tolerant investor should see that as a good thing, not a bad thing. Now, that's just a couple of examples, not necessarily our best ideas, but ideas that show how we go about filling our portfolios, how we use our worldview and our process to identify investment ideas. Investing is actually very simple, but it's not easy. We have to work to become better investors. That means looking at investing as hunting for mispriced opportunities. And our weapons when we're hunting are our contrarian nature and employing second-order thinking. Most importantly, to do better than the crowd, we have to do something different to the crowd, and that means we have to look where other people aren't. I'll be around for Q&As afterwards, so if you have questions about those two stocks or any others, let me know. Thanks for listening.